Understanding Inheritance Tax on Foreign Wealth, a comprehensive guide. Have you ever wondered what happens to your wealth when you pass away? Well, it's not just about the money you leave behind, it's also about the taxes that might be due on that wealth, especially if it's held abroad. This is where the concept of inheritance tax comes into play, and it's a topic that gained significant attention when Rishi Sunak's wife, Akshata Murthy, claimed non-dom status, sparking a national debate. The non-dom revolution. Before the 2022 scandal, the term non-dom was relatively unknown, but all that changed when it became a central issue in the media. Non-dom status refers to individuals who are not considered UK residents for tax purposes, allowing them to avoid paying UK taxes on their foreign income and potentially avoid inheritance tax on their overseas assets. This revelation brought the spotlight on non-doms and their tax advantages, leading to a significant overhaul of inheritance tax rules. Inheritance tax basics. Inheritance tax is calculated based on the value of your entire estate, which includes everything you own. Here's a simplified breakdown. Spouse or civil partner exemption. You can typically pass on your entire estate tax-free to your spouse or civil partner if you are both long-term UK residents. If not, the rules differ. Estate taxation. For assets left to others, the first £325,000 of your estate is tax-free, and any amount above this is typically taxed at 40%. However, this threshold increases to £500,000 if you leave your main home to a child or grandchild, provided your estate is worth less than £2 million. Married couples and civil partnerships. Married couples and civil partners can also inherit each other's allowances, potentially allowing them to pass on up to £1 million tax-free. Overseas assets and inheritance tax. Now the big question. Do you pay inheritance tax on your overseas assets? The answer is not always straightforward. Residence test. For most individuals, the key factor is the residence test. You become a long-term resident if you have been a tax resident in the UK for at least 10 out of the last 20 tax years. This test starts from the tax year before your death. If you are under 20, the test is based on whether you have been a UK tax resident for at least 50% of the tax years since your birth. Determining UK tax residency. The process of determining UK tax residency is more complex than it seems. Here's a simplified breakdown of the automatic tests. Automatic tests UK residents in preceding years. If you were a UK resident in one or more of the 3 preceding tax years but spent fewer than 16 days in the UK this tax year, you may not be considered a UK tax resident. No UK residents in preceding years. If you were not a UK resident in any of the 3 preceding tax years but spent fewer than 46 days in the UK this tax year, you may also not be considered a UK tax resident. Overseas work. If you work full-time overseas with limited visits to the UK, a detailed calculation is required. If these tests don't provide a clear answer, you move on to the sufficient ties analysis. Sufficient ties for UK tax residency. There are 5 ties that could make you a UK tax resident. Family tie. If you have a spouse, civil partner, cohabiting partner, or child who is a UK resident. Accommodation tie. If you have accommodation available in the UK for at least 91 consecutive days and spend at least one night there. Work tie. If you work in the UK for more than 3 hours a day for at least 40 days in the tax year. 90-day tie. If you spent more than 90 days in the UK in at least one of the previous 2 tax years. Country tie. If the UK is the country with the most days spent within the tax year, and you were a UK resident for one or more of the previous 3 tax years, the number of ties required depends on your UK days spent and previous tax year status. Avoiding inheritance tax on overseas assets. If you are deemed a long-term resident for inheritance tax purposes, you will still be liable for IHT until you have been a non-UK tax resident for between 3 and 10 consecutive years. If you were a tax resident for 2 decades or more, you'll need 10 tax years of non-UK residency to escape inheritance tax on overseas assets. The taper rule applies to those with shorter UK residency. 3 years for 10 to 13 years of UK residency, with an extra year added for each additional year. Expert insight Joseph Adunse from Moore Kingston Smith highlights the complexity of inheritance tax rules, noting that changes effective from April 2025 provide more certainty for Britons leaving the UK regarding the tax treatment of their overseas assets. In conclusion, understanding inheritance tax on foreign wealth is crucial for anyone with international assets. The rules are intricate, and seeking professional advice is essential to navigate this complex area of tax law.